Hello and welcome to the LP Financial Services Forex training class, Introduction to Technical Analysis videos. In Lesson 1, Chart Patterns, we continue with pattern number 3, our Head and Shoulders pattern. A Head and Shoulders is a chart pattern used to predict the reversal of a current uptrend. This pattern is identified when the price action of an instrument meets the following characteristics. Number 1, we rise to a peak and subsequent decline. Number 2, then the price rises above the former peak and again declines. And number 3, finally rises again, but not to the second peak, and declines once more. The first and third peaks are the shoulders, and the second peak forms the head. Investors typically enter into a short position when the price drops below the support of the neckline. The target for a head and shoulders is found by subtracting the distance from the neckline to the top of the head from the bottom of the neckline. Can you see the head and shoulders pattern? When we take a closer look at pattern 3, or head and shoulders pattern, we see the rise and the subsequent drop, which form the left shoulder. The next rise goes higher than the left shoulder, but pulls back to the same support area. This forms the head. One last rise by the buyers takes us up, but we can only equal the peak of the first shoulder, and we subsequently decline. This support area is called the neckline. Breaks of this neckline trigger sell positions. People get short, and the market subsequently declines. The target area for this is to measure the distance from this neckline to the top of the head and subtract it from the bottom of the neckline. This is a great example of pattern number 3, our head and shoulders pattern, which is a reversal pattern. As we look at pattern 4, the reverse head and shoulders pattern, we see that a reverse head and shoulders is a chart pattern used to predict the reversal of a current downtrend. This pattern is identified when the price action of an instrument meets the following characteristics. Number 1, the price action falls to a trough and then rises. The price falls below the former trough again and then rises again. Finally, the price falls one last time, but not as far as the second trough. Once this final trough is made, the price heads upward towards a resistance found near the top of the previous troughs. Investors typically enter into a long position when the price rises above the resistance of the neckline. The first and third trough are considered shoulders, and the second peak forms the head. The target for a head and shoulders is found by adding the distance from the neckline to the bottom of the head. You add this distance to the top of the neckline. Can you see the reverse head and shoulders pattern? As we look closer at pattern number 4, the reverse head and shoulder pattern, we see the drop off that forms this first trough. A subsequent rise brings us up to resistance. The second trough goes deeper than the first trough and then rises back up to that same support area, forming this neckline. One last push by the sellers makes a final third trough, which is equal to that of the first, but not as deep as the second. This subsequently pushes the market upwards, and when we break this neckline area, long positions are initiated by traders. Consequently, on occasion, the market will come back and retouch this previous resistance area, which has now become support, in this retouch area, before we move onwards to our target level. The target for a reverse head and shoulder pattern is calculated by measuring the distance from this neckline to the bottom of the head, and then adding it to the top of the neckline. This is a great example of pattern number 4, the reverse head and shoulder pattern, which is a reversal pattern. In our next video, we'll go over pattern number 5, the bull flag pattern, and pattern number 6, the bear flag pattern.